Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, Louisiana's Steve Scalise drops out of the race for Speaker of the House against Ohio's Jim Jordan. Ford is reeling with the UAW strike hitting the company in their largest and profitable plant facility in Kentucky. Oil spikes as Middle East tensions escalate, and Iran is making huge gains in oil sales due to the U.S. reducing oil sanctions in that country. And some of the largest banks today releasing their third quarter earnings. But how much trouble are banks in holding billions of bad commercial real estate loans? If you saw the movie The Big Short about the financial crisis of 2008 with Steve Carroll and others, Carroll, the character, is based on investor Steve Eisman, who with a few others shorted the subprime mortgages, the banks, and other financial institutions. Well, tonight, we're going to be talking with the real Steve Eisman about problems today with banks holding commercial real estate loans. Why are depositors pulling out of banks for better returns? And what is he shorting today? And his thoughts on the stock market. I'm Andre Laborde. We've got these stories and more, so sit back, relax on this Friday the 13th. Don't walk under any ladders, and it's time for Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up. It's Friday, October the 13th. Before we begin, last week we had an interview with John Stoltzfus, the chief investment strategist at Oppenheimer Asset Management, and we were discussing retail and department stores experiencing what they called shrinkage and what, as everyone else knows, as theft and shoplifting. We put up a graph that said in 2022, last year, retail stores lost $112 trillion. What we meant to say was $112 billion. And this week, the CPI for September was released by the Commerce Department, and inflation rose 0.4% for the month and 3.7% for the year. We are moving closer to the 2% target goal of inflation compared to the highest inflation that we had in June of last year at 9%. Now, to bring it back to 2%, it'll be slower and more precise. Overall, inflation from September is at 3.7%, with year-over-year food up just over 3.5%. Rents are up over 7%. And from last year, when inflation was at its highest, we've dropped in both energy and as well as new and used vehicles. So, how did our money do this week? Top stocks for the S&P 500 were Dollar General, Progressive Insurance, and Hess Oil. And the S&P 500 and the NASDAQ had back-to-back weekly losses. The S&P laggards this week were Caesars, AMD, and Rockwell. And this week, the Dow Jones closed today up 0.8 point for the week. The S&P 500, they closed up today just almost at 0.5%, and the NASDAQ, they closed today down just short of 0.2%. Well, there are now about 33,000 UAW members on strike. The United Auto Workers Union stepping up its strike against Ford to hit their largest factory in Kentucky. Now, to put this in perspective, this Kentucky plant is the most profitable plant at Ford, with all 8,700 members walking off the job yesterday. And this one plant, now on strike, makes up almost 20% of Ford's U.S. production. Truck plant that produces the Lincoln Navigator, a Ford's Expedition, as well as all of the F-Series of trucks. Sean Fine, the president of the UAW, is clearly wanting to hit Ford where it hurts at their highest profitable vehicles, the trucks. And this week, OPEC released its World Annual Report. It's a 200-page document looking at next year and the years ahead and the widely followed in the world of energy. Now, today, we're using just under 100 million barrels a day of oil, and it's climbing to just over 110 million barrels in 5 years from now. And it's supposed to grow to 116 million barrels a day by 2045. Now, you can say and expect an oil group to be bullish on oil, but OPEC has been mostly correct in its estimates. As an example, In their 2008 oil outlook, they pegged oil now to be almost exactly for this year. Well, many of the major banks today reported earnings, but hidden are loans held by regional and larger banks or commercial office real estate loans. Now, why are banks important? Well, like Willie Sutton said, that's where the money is. People aren't coming into the office as before COVID, so landlords are not having the cash to pay for their mortgages, and depositors are pulling their money sometimes out of the banks to get higher rates somewhere else. Joining us tonight is the man who shorted the subprime mortgages in 2008, known as CDOs, to talk to us about banks, investing during the Israeli war on terrorism, and much more. He's the portfolio manager at Neuberger Berman, Steve Eisman. Hi, Steve. Welcome to Wall Street Wrap-Up.
Thank you for having me.
Steve, with the events this week with the Middle East of Israel, Hamas, Iran, does that alter your investment strategy in any way?
God, I wish you hadn't asked me that question.
And at the very beginning, too.
I've been too much in a state of shock and rage, really, to be able to think clearly about it. I mean, I never thought that I would see mass pogroms happen again in my lifetime, because I thought that's what my grandparents left. And I've tried to think about it somewhat during the day, and I cannot, unfortunately, I have been looping on a quote that I learned a long, long time ago when I used to study Talmud, which in the original form was Habala hargecha hashkem lahargo, which means when your enemy is coming to kill you, get up early in the morning and kill them first. And I just can't. It's going to take me days to process this. It really will.
As I think most people are the same way. People in the United States are still in the state of shock. Do you think that oil will be going higher for longer?
I have given up a long time ago trying to predict oil prices in any particular way. As I like to say, it's above my pay grade.
I was young at the time, but it was on October the 6th, which was one day before this tragic event, but in 1973 with the Yom Kippur War. And because the United States sided with Israel, the Arab states were upset, and we had the gas lines, and it was so bad that many people may not know this, but I mean, who were not around or too young, but the last number on your license plate, if you had an even number, you're allowed to get gas on one day. Odd numbers were you.
I remember I used to sit in line with my father.
Yes.
When used to do
and it was the same way with me, Steve. Same way. I'm curious, do you think oil is diversified so much now that we won't be going back to those days?
Oil as a percentage of the U.S. economy is so much smaller than it used to be. We're much more diversified. And nor do I think that, I mean, this is just my personal opinion, I don't think that what's happening in Israel right now is going to have any impact on the flow of oil. I don't think the Arab nations are going to do anything about that one way or the other. They'll keep flowing the oil. So I don't think that is an issue.
From the beginning of the year, from January 1st till the end of June, we had something like and I'm talking about major bankruptcies of companies of $1 billion of assets or more. We've had about 16 of them. And I'm thinking of, Bed Bath & Beyond, Yellow Trucking, others like that. Do you see that, I mean, we're in the fourth quarter right now. Do you see more business bankruptcies coming up?
I mean, the number of business bankruptcies so far this year has actually been small. Credit quality in the United States is actually superb, which is my area of expertise. Consumer credit quality is very good. I mean, it's starting to normalize a little bit, but it's normalizing from a level that is so low that it's not going to have an impact on the economy. Commercial business bankruptcies are still very, very low. Bank balance sheets are in good shape. The only area that's eventually going to be a problem is that everybody knows is commercial real estate. But that's a problem that I think will largely be confined to that sector. And it has what we like to say in our business, a very long tail. meaning consumers will, if there are problems, will default quickly. Businesses take a long time, so this will be a long, slow evolution of a situation. I mean, is it possible that eventually we'll have a recession? Sure. Although there's no data at this point to say that there is one coming. I mean, even those economists out there who I respect, who are predicting a recession, would be the first to admit that there's actually no data currently that there's a recession on the horizon. I mean, everybody saw the jobs data on Friday, which was kind of shockingly very strong. So, and the other thing, I get on do a lot of interviews in my life, and and no offense to you, but people are like begging me to say it's a calamity, it's a crisis, it's happening again, and it's not.
Well, I remember either reading what you said or seeing another interview show that you had done where you said that this is the most anticipated recession that has not happened. So
Correct.
Yeah, if I had the words about right the way you said it. So
now, not only do you have the words right, but they're actually not my words. I'm quoting my sister, who made it up first.
Well, we want to give proper credit, so we'll give credit to
Let's
both.
give proper credit where credit is due.
To both Eisman families members. Okay. Well, what about, you brought up about commercial real estate with REITs, real estate, let's say take about real estate investment trusts. And specifically, I'm thinking about commercial office REITs. So you're looking at landlords who, do they have the tenants, which means can they pay the note? And when those notes come due, are they going to have to roll them over because they don't have the money to pay the loan? Will banks let them do it because they don't want the real estate? What do you think is going to happen?
Well, you're actually seeing it. Interestingly, usually in a credit cycle, whatever the credit cycle is, the weak hand goes first. And then if it lasts a very long time, even the strong hand goes. But interestingly enough, in the last 6 to 9 months, people like Blackstone, Brookfield have actually given A quality buildings back. They've given the keys back to the banks because they know that eventually the debt is going to have to be refinanced 2025, 2026, let's say. They don't have the tenants. They don't have the rent rolls. And so they gave up. You're going to see a lot more of that. I don't think banks are going to be too... Now, there's one thing in the banking business that they sometimes do, which is they like to call extend and pretend, meaning they'll just roll over the loan at the same rate and hope the problem goes away, which is why these problems tend to evolve slowly. But they'll evolve. More
regional banks do the real estate loans, from what I understand, than the large ones. Are we looking at problems coming up in the foreseeable future for not just the small regional banks, but maybe even the larger ones as well?
Well, the large ones, when they originate commercial real estate loans, will package them and put them into commercial mortgage-backed securities. So the last time I looked,
well,
at something like
Steve, that sounds like a harbinger of back in 2000 mortgage-backed securities. You're not going to bring up collateral debt obligations, are you?
Look, I could start to go into my comedy routine about calamity happening. It's not, when you compare the size of the residential mortgage market versus the commercial real estate market, the residential mortgage market dwarfs it.
Okay.
So this is going to be a problem. About 60% of all commercial mortgages are held in commercial mortgage-backed securities, so that'll be a problem for their investors. And about 40% are held by regional banks, not the large banks, and that will be a problem for some particular banks. And with respect to those banks, regulators might have to do something, but it's not going to happen today. It'll eventually happen.
Michael Barr is with the Federal Reserve, and I think he is either recommending or he can demand. I'm not sure his power, but he
has his power. Let me give you the regulatory lay of the land.
Okay.
When Dodd-Frank was passed, a new position was created in the Federal Reserve called Vice Chair of Financial Supervision.
Right. Okay.
Which is just a fancy word of saying Chief Bank Regulator of the United States of America. It's actually a shocking statement to say that before Dodd-Frank, there was no chief banking regulator of the United States of America, which doesn't exactly say a lot of wonderful things for us. But
right.
But currently, Michael Barr is Vice Chair of Financial Supervision, so he has a lot of authority.
Well, he was saying how, if I understand correctly, that he wants now banks to have 20% more cash reserves on the sideline for banks. And I'm assuming for that's both regional and also major banks. But if they're going to
I think
raise
he
the
said
cash...
capital, not cash reserves. There's a big difference.
Okay.
Unfortunately, what I think Vice Chair Barr is doing is I'm trying to remember the quote. Generals like to fight the last war.
Mm-hmm.
So, what was the last war? The last war was banks had a lot of bad credit, and they didn't have enough capital, and that all that bad credit was largely in the large banks, and the system blew up. So, after 2010, the then Vice Chair of Financial Supervision, Daniel Tarullo, increased the capital requirements, made the banks reduce risks, and made them keep a lot more liquidity on their balance sheets. But the liquidity aspect was only for the large banks. So one of the major reasons why Silicon Valley blew up is they were not required to have that kind of excess liquidity on the balance sheet. So what they did was they went out and bought some very large amount relative to their size of long-term U.S. Treasuries, and when rates went up, they were underwater. And then when their depositors, venture capitalists, started to pull the money, they had to sell the bonds at a loss, and goodbye Silicon Valley.
Do you think that there will be more banks that are doing that? They just haven't uncovered them yet, that are doing identically like what Silicon Valley Bank is doing by buying long-term treasuries when they actually need it short-term?
Well, that ain't an easy question to answer. But what I would say is that Silicon Valley went under for two reasons. One was they had a lot of bonds that they had massive losses in. That's not enough to sink a bank. What you also need is depositors fleeing, so you have to sell. And not clear if that's going to happen to other banks, but hopefully the regulators will have time to work it out.
I mean, I think with Silicon Valley, they insured depositors up to their above their $250,000 level. That they went. I mean, they actually didn't. No, they actually didn't. All right.
They said they would.
Okay.
But then they didn't. They created some programs that gave those banks liquidity, and they hoped the problem would go away. So technically speaking, your deposits are not guaranteed above $250,000. I don't think most people know that.
Right. Well, that's what I get for only reading the first paragraph and not the second paragraph.
Well, what happened was you listened to the government that Sunday night,
yeah,
but you didn't listen Monday morning.
You know, you always got to listen to part two on Monday morning.
Listen to the end of the sentence.
It's a whole different scenario.
Whole different scenario.
Well, you know, Steve, the definition of insanity is sometimes doing the same thing over and over again, thinking you're going to get a different result. And I remember a couple of months ago, the government, I think it was the Biden administration, said that to get people to get in more home ownership, what they're doing is they're going to lower the credit rating so that if you have a lower credit rating, you'll be able to get a lower bank rate. But if you have a higher credit rating, in other words, you've got stronger credit, you're going to have to be paying more.
Yes.
What do you think?
One will Well, it's not. Look, again, it's above my pay grade. It's not an insane idea in the sense that the people who can really afford, have the perfect credit, if they pay a little bit more, they'll subsidize the other people who can't afford as much. It's not a crazy thought. The only thing I would say about the mortgage market currently is that credit quality is impeccable. But that's not the problem with the housing market. The problem with the housing market is that pretty much everybody who owns a home today has a 3% mortgage. People who want to buy a home today the current mortgage rate is like 8%. So, one thing I learned very clearly when I was in grade school was that the number 8 is a lot higher than the number 3. In case anybody wasn't paying attention. And I actually calculated that if, let's say somebody bought a house, just make up a number, for $300,000. It doesn't matter, actually, the number, but let's just say $300,000, and you had a 3% mortgage. For somebody to buy your house today at an 8% mortgage, to have the same monthly payment as you do with a 3% mortgage, the house price has to be cut in half.
Well, I would imagine, Steve.
The house price has to be cut in half. But here's the caveat.
Okay.
As long as people have jobs, they're not going to sell their home for half. So what the situation in the existing housing market today is there are no sales because nobody wants to sell their house down, especially when they have a job. And the people who want to buy don't want to buy the house at the same price because the monthly payment's too high.
But do you think that there are more people with lower credit ratings than higher credit ratings? So if like you say, if one oversets the other, if the people with good credit are subsidizing those with bad credit, I mean, I remember, and I know you do, like back in 2007 or prior to that, Barney Frank, who at the time was congressman from Massachusetts, said, let's roll the dice, see what we get. And they rolled the dice and see what they got. He rolled them.
He rolled them. But you know what? It's a little unfair to say that Barney Frank actually rolled the dice because the bad mortgages, most of them were in the subprime market, which was really an unregulated market. The government really didn't. I mean, Barney Frank liked to say that he rolled the dice. He didn't really roll it. Wall Street rolled it for him. Okay.
Well, like we were talking before about Dodd-Frank, are there more rules on the subprime mortgage that what happened in 2007 and 2008 won't happen again?
There are no subprime mortgages made in the United States today. Almost none. It's just not done. It's just not done.
Okay.
It's a shocking statement. I mean, it used to be a $500 billion a year volume business. Mm-hmm. I mean, the amount of subprime mortgages that are made in the United States are probably so small it's a rounding error. It's just not done.
Are you shorting any banks right now?
Well, I don't short anything for clients anymore. We're long only.
Okay.
And the only type of shorting that I have is just for my own personal account, and I'll just keep that information to myself.
Okay. Well, how about if I ask it this way? What type of banks? What type of sectors do you think that are too overvalued?
What kind of sectors? I don't really think of it that way per se. I mean, you could make an argument that parts of tech are overvalued, but on the other hand, it's the most dynamic part of the U.S. economy. If I think something is overvalued, that doesn't necessarily mean it's a calamity is approaching unless the fundamentals are about to deteriorate. One of the things that sort of, let me put it this way, on the long side, buying something because it looks cheap is usually a value trap. Mm-hmm. And shorting something just because it looks really, really, really expensive is usually a recipe for losing a lot of money.
At one time, there was like a little over $5 trillion in the economy in cash reserves. But now people are taking money out of whether it be COVID money drying up or whatever the case, but there's not as much as it once was. Do you see private credit rather than banks? Because remember we talked about Michael Barr just a little while ago. So first off, do you think banks are going to be more stringent on their loans? And if so, with more businesses having problems, are they going to now go to private credit as a possibility of getting bank loans?
Yeah, the answer to that question is yes, yes, and yes.
Okay.
So let me elaborate on 3 yeses. So during COVID, because of all the money that came in and nobody had anything to do, trillions of dollars went into the banking system in the form of deposits. And now that rates are up, that money is leaving and going into money market funds. There's probably something like $2 trillion worth of excess deposits still in the banking system. And I think over the next couple of years, assuming rates stay up, a lot of it will leave. So if you're a bank and you're losing deposits, that means you have to make fewer loans because the deposits are the way you fund your loans. So throughout the banking system, you are finding banks are tightening their credit. If you're a bank and you're tightening credit, but the economy is still good, somebody else is going to make that loan. And that's happening now in the outside of the banking system with companies like Apollo or Blackstone or some of the
BDOs,
what you call small business,
BDCs,
BDCs, et cetera. Mm-hmm. And that's going to continue.
What about last week? We had John Stoltzfus on the show, and John is the chief investment officer at Oppenheimer Asset Management, and he said that industrial stocks he was very high on because with government money being put out for bridges and other types of industry, that he liked that sector.
It's, first of all, there's about $1.2 trillion that the United States government is going to spend in the form of either direct spending or tax credits that will be in a bunch of different areas. I think this is a massive opportunity to invest in over time. And yes, I'm very, very positive on it.
Steve, I've got a lot more questions, and I hope you come back for a part 2. I thoroughly enjoyed it.
Okay, thank you very much.
Thank you, Steve. Hey, if you have a question or maybe a comment about the show, well, we would love to hear from you. Make it concise, make it piffy, and write us at andre@benecapital.com. Now, for a wrap-up on Wall Street. Social Security checks will be going up in January, beginning next year, due to inflation. Starting in January, Social Security benefits will be rising by 3.2%. Amounts are adjusted due to the COLA, or cost of living adjustment, decided by the annual CPI. And if you're planning a trip to Disneyland or Disney World and you bring the kids, definitely you need to bring some more money. Since losing on the movies and Disney streaming and also a falling stock price, the Mouse House will be raising prices on by more than 8% for a one-day ticket, and a 5-day ticket at Disney World and Disneyland will be rising by 16%. Now, that, of course, is in addition to their raising prices of parking, of souvenirs, and food. And as anyone knows, you can't get out of Disney without parking, food, and lots of souvenirs for the kids. Well, next week, it's going to be the 50th anniversary of the Arab oil embargo. And as this week's CPI number is bringing inflation to the 2% that the Federal Reserve wants, what type of stocks should we be investing in for the remainder of this year? And should we expect another market downturn as maybe we had in August and September? Join us next week when my guest is going to be Glenmead Capital's Chief Investment Officer, Jason Pride. Jason at Glenmead has over $42 billion of assets under management. That's Jason Pride next week. And that's a wrap-up for our show this Friday, October 13th. Our thanks to Steve Eisman for being with us this evening. But as always, we appreciate you for allowing us into your homes tonight. Have a fun weekend with the ones you love. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.